Thank you for tuning in to Starkey Multifamily Podcast. I have with me Mauricio Rauld, and he is an attorney that specializes in syndications and such like that. Thank you for coming on.
Thanks for having me, Reed. I really appreciate it.
And before we get too started, tell me a little bit about you and what you do.
Yeah, so I'm what's known as a syndication attorney, which is just really a fancy name for an SEC lawyer. I make sure that primarily real estate investors, although it does apply to pretty much anything, anybody who's raising money, but I help real estate investors raise capital in full compliance with federal and state securities laws. So anytime somebody needs to raise money, there's a whole bunch of regulations and compliance that one has to go through. And my job is to make sure that my clients navigate those without stepping on any landmines.
So basically, syndication is done a lot of times to fund multifamily apartments as well as many other things outside of real estate. Can you tell us a little bit about what a syndication is?
Yeah, it's really simple. The syndication in its most basic form is simply the aggregation of resources. Most people think of capital, but it's you aggregate resources so that you can then put that aggregation into something, whether it's real estate, whether it's stocks, bonds, whatever you want to invest in. And I say it doesn't have to be capital because people forget that you can aggregate and you can syndicate, credit, your credit, your relationships, your knowledge. There's a lot of things that you can bring people in, but the idea is you're bringing a bunch of people, and through the power of the group, you're able to take down much larger assets that you ordinarily wouldn't be able to do yourself. So it's just a great way for someone to scale their business, in the real estate world, let's say you're investing in single family homes yourself. Now you want to make a jump into, multifamily apartments, which are sometimes in the millions. You don't have $1 million, so you go get your friends and families and people to help you put that money together, and you're the organizer of that deal.
So where does that line get drawn? So I see a lot of people, on smaller deals, maybe let's say a single family home, and maybe they don't have the money, but they reach out to a friend who says, hey, I'll give you $50,000 to put into this, and you run it. To my interpretation, that is still not completely legal. Am I correct in that?
Yeah, I mean, there's ways to fix that, easily fix that. But yeah, the general rule, the way I like to present it is anytime you are taking money from someone where the returns are generated by your efforts, meaning they're just giving you the money and you're doing all the work and then you're producing a return, that's a security. That's the definition of a security according to the SEC, the Securities and Exchange Commission. And that's very broad. So yes, in theory, if someone passively simply writes you a $50,000 check and then goes home and sits on the couch and waits for you to do all the work and then send them interest or a return, that's going to be considered generally a security. Now, there's a couple of exemptions, big picture exemptions, that I think most people in that scenario would look at. That your scenario tends to show up a lot with people who like to flip. So they like to buy a piece of property with that investment, fix it up, and then sell it pretty quickly. There's a couple of ways that you can structure that, but that would be an exemption to the definition of a security. But in general, that's going to be security. So we want to make sure that, again, you're talking to your counsel to make sure you structure it in such a way that you avoid being considered a security, because once you get tagged with that name of being a security, now that opens up your whole nightmare of having to comply with all the securities laws if there's a quick fix and doing it a certain way, and that saves you all the compliance, which is both costly and time consuming.
Is that what do you know what exemption that is?
Yeah, so let me give an example. So a promissory note, for example, so that's why the smaller amount, if you do a note that is less than 9 months in duration, and that's why the flippers is a good one to use it. So if you borrow money for 2 months and it's one person, one note, it's not fractionalized, then by definition, a note that's less than 9 months is not considered a security. Conversely, also, if you get a note that's secured by a mortgage, it is a security, but it's exempt. It's one of those family of situations that would not be considered security. Again, I want to be very clear. It has to be one person, one note, not a fractionalized. The minute you start having 3 or 4 or 5 people loan you money in the form of a note, that's going to be a security. But if it's just your buddy Johnny who writes a $50,000 check, like you said, and then you secure it with a mortgage, then most likely that's going to be an exemption to being a security, and you wouldn't have to worry about the securities laws.
Okay, well, that was very, very helpful. So let's go back into the bigger stuff. So typically there's a 506B and a 506C. Can you explain real quickly the differences between the two of those?
Yeah, let's just backtrack a little bit. So other than those two little exemptions, generally when you do what we're talking about, you're raising money from passive investors, you either have to register that security with the SEC or you have to find an exemption. And what you're talking about is a couple of exemptions that most people rely on, these 506B as in boy and 506C as in Charlie. Those are not the only exemptions. There's several others, but those are the ones that are most commonly used. I'd say about 95% of the people use them. And there's really two pivot points that I like to point out on both those exemptions. They're both very similar. They both allow you to raise an unlimited amount of money. They both exempt state law, so we don't have to worry about the states too much other than the anti-fraud. But the real difference is, number one, advertising. So if you want to advertise your deal, you're going to have to rely on 506C because C allows you to do that. 506B does not allow you to advertise. So that's going to be the first question I'm going to ask you if you come into my office and you're like, well, which one shall I pick? I'm going to say, do you plan on advertising or do you have some kind of an existing relationship already with the people you want to reach? And if you say, no, I mean, I've got some people I know, but I really want to go on Facebook or I really want to go do all these advertising, these marketing, then you're going to be limited to 506C because otherwise it's not allowed. And then the other pivot point has to do with the type of investors that you're going after. If you want to go after what's called non-accredited investors, meaning investors that don't have $1 million in net worth, excluding their primary residence, or don't earn $200,000 a year, then you have to go a 506B route because that's the only exemption that allows you to take non-accredited investors. Now, the problem, again, with the 506B is that you cannot advertise. So you got to pick your poison or pick your fruit, I guess. So if you want to take non-accredited investors, then you cannot advertise. If you want to advertise, you've got to stick to accredited investors only.
So there's a couple of points that I see confusing on both of the B and then the C. So I'll start with the B. What is the established relationship? Because you see a lot of people that really push the envelope on where that line is. So what is your opinion on that?
Yeah, I did a video, it's been a while now, I guess, but I have a YouTube channel that has a lot of these videos. One of them is how do you take a complete stranger that you've just met either online or at a meetup or at a seminar or whatever, how do you take that complete stranger and establish that substantive relationship, that pre-existing substantive relationship? And luckily for us, unlike most things involving the SEC, we've got some pretty good guidance on what it takes. And the SEC has been very clear that there's no magic timeline. It's not 30 days. There's no magic amount of times you got to communicate. It's really, you've got to interact with your investors or your potential investors to a degree that you establish this substantive relationship. And that generally includes things like sending them a very detailed questionnaire to find out information about your investor. And it's not just general information, but specific, detailed investment type questions like, obviously, are you accredited? Are you not accredited? What's your investment experience? Have you done syndications before? What's your amount that you can invest? Like really get really detailed questions. So, because what you're trying to figure out is whether this person can really understand the merits and the risks of your deals. Are they sophisticated enough? And then for you, is this really an investment that's suitable for them? Because if you're talking to a 99-year-old widow and they're going to put their last few dollars in with you, and this is a development deal that's not going to work it's not going to return money for another 5 or 10 years, you've got to know that doesn't match. So that's probably step number one, is putting that questionnaire together. And then number two is getting on the phone or having a cup of coffee or having a one-on-one interaction with this person, probably going through the questionnaire. And again, just kind of having a conversation with them. So, again, you can get to the point where you understand, you can figure out their level of sophistication, which is what you really want to do. And then once you've decided, you want to keep good records of this because it's going to be on you to prove this. But once you've established, it's really a self thing. You decide when you think you have a substantive relationship. But then let's say today is the day that I've decided, look, I've spent enough time with Reed. We've been on the phone a couple times. We've exchanged emails. I've shown him stuff, that he's looked at the website. I'm comfortable now that today I have a substantive relationship with Reed. Well, I can now offer you my future deal. I still can't offer you a current deal because the rule is I must have a pre-existing substantive relationship, and that means pre-existing the offering. So once I do all my homework and get to know you, I've got to wait for the next deal to be able to offer to you, because at that point, I will have known you and it would have predated the offering.
Yeah, and that kind of goes into the second part, is advertising. So I think it is kind of redundant, because if you think about having that relationship, advertising, it doesn't really do you any good. It doesn't benefit you at all because you're supposed to already know the person before you have the deal. But some examples that I see are clearly Facebook when they say, hey, I got this under contract, I'm really excited about it. They're not asking, well, some of them are asking, but sometimes just mentioning that, in my understanding, that is illegal as well. So where are those lines and other things other than social media that people are crossing that maybe they should not?
This is such a hot topic, Reed, that I've actually put together a little video series that kind of goes through this. And the way I like to think of this, you're right, you're trying to figure out what the line is. And to me, there's really three buckets. There's the bucket where it's clearly okay. Then there's a bucket that it's clearly not okay. And then there's that middle bucket, which, kind of is a little bit of a blurry lines and, just depending on how aggressive you want to get. But the bottom line is, first of all, if you're doing a 506C, then you can do whatever you want on social media, right? So we're only talking about scenarios where you're doing a 506B that prohibits advertising. And social media, Facebook, just as your website, just like your podcast, like all these things are blasted to the public. So we've got to be very careful about what we fill those pipes with. So let's take Facebook, for example. The SEC has said that factual information about you and your company is fine. They understand that you've got a business to run, and putting information out there about what your company does and your resume will be okay. That's factual information about you or your company. That's okay. The other thing that I think is okay is, as long as you don't have a deal, let me just backtrack a little bit. I tend to recommend, if you have an active deal, stay off Facebook, stay off social media. Don't even go there. It's just too risky because there's so much room for interpretation. Any of these posts that you make can be interpreted as what's called conditioning the market. Conditioning the market means not only directly promoting your deal, but anything that drums up interest about your deal, directly or indirectly. So my favorite are the ones of people who are at these walkthroughs, they do due diligence on the properties, and they're walking the property and they're doing content. And inevitably, it's either slips up or it's pretty obvious that this is for a deal. So it's very clear from watching a video that they're raising, it's a large building and they're raising money, even though they may not talk about it directly. That can be viewed as conditioning the market, because anything that gets people excited about maybe picking up the phone and calling them and asking them about whether the deal is open or whatever, can be conditioning the market. So that's why if you have an active deal, I want to stay away from there. But what you can definitely do if you don't have a deal, which is, by the way, the best time to add to your list, is in between deals when you don't have anything to offer. Value add. Putting content on Facebook that has nothing to do with a particular offering that you have or a prior offering or anything, just literally educates the public, and an exchange requires some type of information, whether it's usually an email address, but anything like that. So, for example, putting a report together on why, if you're into real estate, why real estate is the greatest asset class of all times and the greatest wealth creation vehicle ever made, or why Florida is the greatest real estate market right now and it's the hottest place, and you can do an article that, or maybe just a webinar, whatever you want to put together that allows you to get a contact information. That's going to be fine. Now, that doesn't mean you can offer them your deal, which hopefully you don't have one because you're doing it in between. But even then, if you had a deal tomorrow, you wouldn't be able to most likely offer it to them, because again, you've got to go through those steps that I just talked about, which is, now I've got their information. They're a complete stranger. Now I'm sending you the questionnaire. Now I'm getting on a phone call. Now I'm asking you to go look at my website. Now we're exchanging emails. We're getting to know each other, and that's a process. Whether it's 2 days or 2 months or 2 years, it depends on the quality of the interactions. But that to me is where I would draw the line. Value add, what I call value add marketing, just add a ton of value, and people, look, I do this all the time, by the way, and I don't even look for a lead magnet. I'll put out content, and guess what? People will find me. They'll DM you, right, on Facebook, or if your information is typically on a YouTube channel, for example, your information, they'll find you. So if you're providing value to them and they're interested, they're going to reach out to you, they're going to find you, and then go through those steps and establish that substantive relationship. That's the way to do Facebook and other social media, in my opinion. Yeah.
Now, in my circle of friends, we have most of them, in fact, almost all of them are doing 506Bs. Now, when I look at that, so having those lines about not being, being careful as to what you say and where you say it, and and then also having to deal with somebody who, if they're not accredited and they give you 50 grand, that's a large chunk of their net worth.
Yeah, and what there's no magic number, but that's another thing that you bring up that we don't usually talk about, which is nice, especially if they're non-accredited. you don't want to take all their money, right? Like you said, if $50,000 is their last $50,000, it's their retirement money or whatever, even though I would argue legally you wouldn't be able to take it because then that would not be a suitable investment for them to put the last $50,000. But you don't want to take somebody's last $50,000. You don't want to take their last anything. So the rule of thumb is typically, again, it's not etched in stone, but maybe 25 to 30% max of their, sort of liquid net worth that they have to invest. If they're looking to invest a bunch of money, maybe limit yourself at 25 and 30. And again, how do you know that? How do you know that information? It's part of that questionnaire. It's part of those phone calls you have where you can ask, hey, what's your net worth? How much money do you have to invest? Oh, you've got $200,000 to invest. Great. 50 grand seems reasonable. That's 25% of that. But if they tell you, hey, I'm dipping into my 401k to make an investment and it's all I've got, and that's probably not a good idea to take their money.
Yeah, it may seem good when you're raising money and trying to get that goal, but when they're calling you every day because they're panicked, I think that's a trade-off that I wouldn't be willing.
And you know what? That's one of the reasons a lot of clients, even though they're allowed to, elect not to take non-accredited investors, because especially when things don't go the way they're supposed to go, typically the non-accrediteds have a lot more of their percentage of their net worth tied up in your deal. So they're a lot more concerned than maybe an accredited investor who's got all this money and, maybe they're $50,000, whether they lose it or not, it's not going to make a difference to them. But if you're talking to somebody who's, $100,000 is all they've got, and that's 50% of their money is with you, and that money gets lost, that's a huge deal for them. So they're usually the ones that are first in line to calling you and, following up with you. And a lot of clients they just don't want to deal with that pressure and that responsibility of taking their money. So that's why a lot of people, 506B, by the way, just to backtrack, 506B, you could do billion-dollar raises. So most of these huge raises, these big, Goldman Sachs or JP Morgan, these banks that do these huge, they use 506B. They just don't take any non-accrediteds, obviously. They're all taking really sophisticated, high-level investors. But just because you're doing a 506B doesn't mean you have to take non-accrediteds. You just can take up to 35 of them, and you better make sure they're sophisticated. But a lot of people don't want to deal with that because of what you just mentioned, the pressure and the responsibility of taking their hard-earned cash.
Yeah, so I guess maybe you can shed some light. So when I look at it, a 506C makes more sense because then I don't have to watch what I say and where I say it. I can talk about the deal as I deem necessary. And by default, I'm eliminating everybody that is non-accredited. To me, that seems simpler.
So let's talk about that. Well, one thing to clarify is you still don't have carte blanche, right? You can advertise, but there's still what's called anti-fraud provisions, which obviously doesn't mean you have to be doing fraud, but you've got to make sure that your statements are complete. So you got to be a little bit careful, especially when you're doing stuff on social media, especially on Twitter where you have X amount of characters. You just got to be careful about maybe putting a link to another place that has a little bit more information. But yeah, the big knock with 506, I love 506C, by the way. So, but the argument against 506Cs are, number one, people who start off have people in their network, friends and family, who maybe if this is your first syndication or second syndication, those are the people that probably going to invest with you first. And it's very difficult, even no matter how good you are on social media, it's very difficult to grab somebody that you've never met before right off of social media and then have them write you a $50,000, $100,000 check. It's been done before, but it's not easy, right? Usually people want time to get to know you. Maybe they've met you at a seminar and they've had multiple phone calls and they get comfortable with you before they invest. So that's one of the reasons, people, rely on the 506B because they already got that network. And then it does limit you. I mean, I don't know I forget what the latest percentages are, but there's only I think it's 7 or 8% of the US households are accredited. So it does limit your pool. So again, if you've got a huge list, that you can potentially offer this to the investors, but 80% of them are non-accredited, then that does limit your ability on your existing list to offer them. So you've got to go outside. But I think going outside takes a little bit of time. It's not something you just, hey, I'm going to do a 506C. I've got nobody on my list. Let me just start putting out some ads and some marketing, and suddenly people are going to write checks to me. There's a process, which is why, by the way, that's why I encourage people to work on this in between deals. That's the best time to go add to your list and enter in those relationships. Once you have a deal under contract, I'm not saying you should have all the money raised, but you should already have everybody that you think you're going to have, in that deal, because bringing brand new people into that deal is going to be tough.
So one of the biggest fears, I think, for somebody going into a syndication is, and maybe a 506C is a little bit of a safety net for that, allowing you to advertise if you run out. But the fear that I know I have, and I'm sure many people share, is, okay, so I know that I have people I've talked to that say they will commit X dollars, and I just also know that talk is cheap. So when I go to show them that deal, at least half of them are going to say, now's not a good time.
At least.
So that's the fear, is you're raising $1 million and you come up with 800,000 and you're stuck. And you talk to everybody that you know, and there's nobody left. So that's kind of the good segue into money partners, which, it's not legal to compensate for bringing in capital. What ways could you do that? So let's say you have somebody that you know that has a network. Can you bring them on as a partner? What will they need to do to be legal to bring in that extra 200,000?
Yeah, so you cannot compensate someone for bringing in the capital in and of itself. They have to be doing what we call substantial work. So the way to do it is to bring them in as a legitimate co-partner, or what we call a co-sponsor in your deal. So typically, you can do this on your own, right? You could organize this syndication on your own, or a lot of people partner up. So they have another partner. So there's two of them, you kind of divvy up the work, and you can bring in a third person or maybe a fourth person. I wouldn't go too crazy, but let's leave it to three. Let's say you and I are usually in partners, but I'm going to bring in, I'll give you a great example. I have a client who, they buy property all over the country. So they may not know the, Fort Lauderdale, Florida market as well as they know in other markets. So they have somebody who's boots on the ground in Fort Lauderdale, who knows that market really well, who has all the relationships. They bring that person in to become a legitimate co-sponsor. They're going to be adding a lot of value to our deal. Incidental to that, they have a network and they can go raise a bunch of money. And so obviously if they're a partner and there's three of us now, we can all tap into our respective networks to raise the money together. But I'm not bringing that person in just to raise the money. I'm bringing them in because they're an expert, boots on the ground in Fort Lauderdale, have all the relationships with the property managers and know the neighborhoods and just has all the relationships. They have to be doing this really two primary words, and one of them is primary. They've got to be doing substantial work, meaning they've got to be doing real stuff, not just raising money. And so in my example, asset management or relationships or what have you. And the primary responsibilities or their primary duties in the syndication must be focused on those substantial duties. To me, the primary means 50% or more. So 50% of their activity has to be on actually doing the thing versus, raising the capital. If a regulator was ever to ask somebody, like, what did this person do in order to get whatever compensation they got? The answer cannot be, well, they helped me raise money. It has to be something else. Like if I took that off the table as an answer, what would your answer be? And it better be substantial.
So what about two partners? So let's say you and I partnered on a deal and you bring in more capital than I do, but we're partners on the deal and we're doing everything 50-50, but you bring a lot more money. Can we compensate you more? Like, can we change the ownership percentage on that deal?
If the only difference between what you did and I did was I brought in more money, it would be dangerous to apportion the percentages differently. If assuming, and of course we're never going to be 50-50, but assume everything else was literally 50-50, and the only difference was I was able to go raise more money, then how else would you justify the fact that I got 60% and you got 40%? How are you going to justify that gap other than, well, he brought in money? That means I'm getting compensated to raise money. So can you get compensated differently? Of course. If I'm doing more, and look, there's plenty of people who do this on the weekends, right? There's one primary sponsor and the other, they're working on weekends and evenings. And so they may not be able to contribute as much. And so they get 10 or 20%. Or maybe their specialty, like I mentioned with my Fort Lauderdale example, is very specific. Like they're really good at underwriting. They're one of the best underwriters, or they really know that market. So they're going to really help me with acquisition. And that's about it. Then I'm not going to give them 50% of the deal. I may only give them 10 or 20, but it's based on merit and the amount of work you're doing, or maybe the amount of capital you personally are bringing into the deal. But I would stay away from changing percentages based on the amount of money raised, because then that makes that connection, which you're trying to avoid. I mean, it's your burden to prove that you're not getting compensated for raising money. That's just not a good fact if that's the only difference in percentage ownership. So I would stay away from that based on raising money.
Fair enough. Now, what about giving ownership for just a key principal? So their only responsibility is signing on the loan. Is that allowed?
Yeah, I like that. I'm a big proponent of that. I mean, signing on the dotted line is a really high risk endeavor for the person. Like, and a lot of times we don't even put them on as, if that's all they do, if they're literally just signing on the loan and getting compensated for that, I'm not even sure they're sponsors at that point. They're literally key principals. And I mean, what is that worth? It depends, right? I mean, it depends on how easy you can get another KP, but there's plenty of people who lend their balance sheets and expect to get compensated for that. And that would not be in violation of any of the broker dealer rules if you're getting compensated for lending your balance sheet, or, just being a financial support. First of all, they're not raising money, right, to do anything. So that's where it gets a little bit tricky, is if they're a KP and they're raising money. But if they're purely a KP and you want to pay them 15% of the deal for lending their balance sheet, then look, I've seen people do it even higher. Because if you can't do the deal without this person, then how valuable is that person to you? It's pretty high. So people always ask me what's the right price, and I always say it depends on the market. It depends on the demand and supply. So if this key principal is the only person that you have, and they want 50% of the deal, and without this person you can't do the deal, 50% may be okay. If this person you have wants to be the KP, and you've got a line of people out the door, 20, 30, 40 people who want to be a KP for you, how valuable are they? Not as valuable. So you can probably negotiate a lower rate. So it's just all supply and demand of KPs at that point.
Now, you did say something, I didn't catch it fully. Did you say the KP should not be bringing in investors?
It depends on their role. Sometimes it depends. I think the way you phrase the question, if they're purely a KP, a key principal, then that's all they're doing. There are a lot of sponsors that will bring in a key principal, and that's all they do. They literally sign on the loan, and they're not involved at all. They're not part of the management. They've just decided to lend their balance sheet in exchange for a cut of the deal. They have a relationship with the sponsor. They trust the sponsor. They think they're going to do a good job. Here's my balance sheet. We can qualify for the loan. I'll guarantee it, what have you. You just give me 15, 20% of your share. I'm happy. In that scenario, there's no reason. I mean, you would list them, but they're not technically sponsors. They're not involved in the deal at all. They're not raising capital. They're not involved in the day-to-day operations. It's not uncommon, though, to have some of the co-sponsors also be KPs. So at that point, you have kind of a dual role. On the one hand, you are a sponsor, but you're also one of the key principals. And in that scenario, that's where they would obviously be a sponsor if that's the role they're playing.
Fair enough. So you mentioned too that the KP has a lot of risk. So I am under a little different impression. So we're assuming a non-recourse loan. Let's say I'm the KP on a non-recourse loan. I go in, all I've done is, given my balance sheet. To my understanding, the only risk that I have is if they're a bad actor and going outside the rules. Is there more risk to a KP than that?
No, that's it, but that's a huge risk. I mean, you don't have any control over what the sponsor or the management company is doing. And if they're violating the terms of the loan, or if they're, if the property can't perform, like whatever those bad boy carve outs are as a KP, especially if you're a KP that's not involved in the day-to-day, that's a risk, which is why a lot of times the KP, incorporates in their negotiations some kind of control at some point. Like if something happens, I'm able to step in, or maybe I have to review the budget, or I need to be comfortable, because if we violate the terms of the lender agreement, then that could trigger it. So there's still risk. There's still risk involved. It's obviously not the same amount of risk as if it was a full recourse loan, because then that's a whole new line. But a non-recourse is not a riskless. It's not a riskless loan. It would necessitate a lower payment because of the lower risk, but it's not riskless.
So a friend of mine said he puts a clause in when he does that, like you said, if they miss a payment, and I think they got to be more than a few days late, but they got to be a certain amount of time past due, he has the option to step in and take over the management. Does that mitigate most of the risk on that then?
You'd have to look at the specific language. I mean, the bad boy carve-outs are specific to the loan agreement. So you want to look at the loan, as a KP, you want to review the loan agreement very carefully to make sure you understand what those carve-outs are. There's different types of carve-outs, so you have to look at that specific thing. The one thing you would definitely have to do in that scenario is make sure you're disclosing that to your investors, because now you're investing in, let's say, Reed. So I know Reed knows what he's doing, and I know Reed, and I trust him, and I'm investing because Reed's in the deal. If there's a scenario where Reed gets put aside because something gets triggered, and now Johnny over here, who I've never met, is stepping in, and now he's taking over the project. Well, he may have completely different interests than yours. Maybe he's at a point where he's a little bit more at risk of his KP and decides, you know what, we're better off selling this thing because I don't want to be on the hook, or I've got different aspirations or whatever. So that's something you'd want to make sure you disclose on your documentation, that whatever the terms are of that triggering event, you want to make sure it's very clear so investors understand when and how much that KP would be able to step in.
Okay. Yeah. Well, and hopefully the attorney would catch that. Correct. Okay. So if anybody is thinking that you can do a PPM or any type of syndication without an attorney, I would say don't.
No, and it's even hard when you do have an attorney, because the attorney can only rely on what the client tells. So in my case, what the client tells me, and my job is to try and pull it out of you, because a lot of times you don't realize that this is an important fact, or you just don't think about it. And there's no other way for me to tell. Like, I don't know what, these verbal arrangements or whatever. So it's just really important to make sure you're in constant communication, especially on the front end with your syndication attorney. Let the attorney know everything that's out there, and then they can decide whether that's something that needs to be disclosed, or they can ask a bunch of questions.
All right, last bit. If you want to bring in international investors, is there any difference in how you treat it? How would you go about that if somebody from another country wanted to invest in your deal?
Yeah, there's a lot of things you want to think about when you have international investors. First of all, there's actually a separate exemption. If all of your investors are overseas, then there's a different exemption called a Reg S, a Regulation S. This 506B and 506C that we've been talking about fall into this Regulation D, Reg D exemption. But let's just say you have, you've got a lot of relationships in Canada, and you go raise a bunch of money from 10 or 15 Canadian investors. Well, look, the SEC doesn't care about foreigners, right? They only care about U.S. citizens and U.S. residents. So if you have a deal that's completely outside of the U.S. with the international investors, you can rely on a Reg S and not even worry about Reg D. Now, the challenge with international investors has several challenges. One, probably the most important challenge you got to realize is that you really do become kind of an agent of the IRS, because when international investors bring money into the U.S. and you're now trying to get money back out of the U.S., you have to withhold 30% of their money and send that to the Treasury Department, because otherwise there's no incentive for them to file a U.S. tax return, even though they're going to owe U.S. taxes. So you have an obligation to withhold 30% and give that to Treasury Department. So it's very important to make sure you're working with a really good CPA that understands the cross-border transactions and can handle that. The other thing that you want to be careful about, Canadians is probably the most common foreign investors that you come up with, because obviously they're our neighbors, but it doesn't apply just to Canadians. But a lot of countries don't recognize our corporate system. So they don't recognize LLCs, for example, which is what we mostly use, limited liability companies. So Canada doesn't have an LLC. And so whenever you have an investment with a Canadian investor who invests in an LLC, their tax authority defaults that to a corporation, and they get double taxed. So if that hasn't been discussed, that's an ugly realization at some point when it's tax time, where the investor realizes, wait a minute, I get taxed twice, my return just went down, they're not happy. So you want to make sure you structure things in a unique way to make sure that double taxation doesn't happen. With Canada, it's typically fairly simple, because you just create a limited partnership for them. That way they're investing in a limited partnership and not in an LLC. But other countries have other types of entities that they don't recognize. You just want to make sure that you're cognizant of that. And then probably the last thing you want to worry about is just be aware. I wouldn't say worry about it too much, unless you're doing, you're accepting cryptocurrencies as form of payment. But there's always anti-money laundering statutes that you've got to be aware of. So you want to make sure you're acting reasonably to make sure that, whoever you're accepting money hasn't, is obviously not on a terrorist watch, or hasn't been, potentially laundering money, to get to you. And, most of the time you're going through a U.S. intermediary bank, and the bank's going to do that. And so I think that's one thing you can rely on. Although I have had some horror stories where money comes in from international and they freeze the money because they're not sure, or they're doing that compliance. So that's something else that you may want to add to that, where if you've got to close, on Monday, and you're getting a huge wire in on Friday the week before, you may want to call your bank and say, look, give them the heads up and let them know that there's a big check. Sometimes this particular example, I think, was about a $5 million transaction. So $5 million was coming in from somewhere abroad, and I forget the name of the federal agency, but some financial regulatory agency froze that money because they weren't sure where it came from, or there was some kind of a red flag. And so it was a nightmare for the client because they, at that point, you've got to go through so many, go up the chart of, you're talking to the branch manager, and then you've got to go up to the senior people, and at 5 million is a big number. So my point in all that is just, if you're going to have a check that's coming in from overseas, just contact the bank and just give them the heads up and let them know, hey, what documents do you need to make sure that when this money hits, it's all streamlined to get released? Do you need passports? Do you need, what information do you need to make sure you're comfortable that this is not violating the anti-money laundering statutes for them?
Yeah, that's great information. So Mauricio, you have a YouTube channel. I've personally watched many of those videos. It's a great source of information. You're a wonderful wealth of stuff on syndications. So
Thank you.
I do appreciate that. But if you can give everybody where they can find you, where they can reach you. And
yeah, so a couple places. YouTube channel under Mauricio Rauld. I got, like you said, a bunch of videos there. My website is premierlawgroup.net. premierlawgroup.net. And if anybody wants that social media, how to advertise on social media that I talked before, if you just want to send me an email, it's social@premierlawgroup.net, social@premierlawgroup.net. I'll send over that 5-part video series on how to legally use social media to add to your list.
Perfect. Well, thanks again. I appreciate it. And we look forward to talking to you later.
Thanks, Reed. Thanks for having me. I really appreciate it.
Thank you.